Let me show you the next slide here, and then I'm going to ask you a question. So this is the forecast, again, aggregated by Bloomberg, that shows expected growth of spending in cloud infrastructure, SaaS, data storage, computing, networking, etc. They break it in two categories that seem to have comparable growth rates, almost an even split here between the infrastructure plays and the SaaS applications. And you see this phenomenal growth from $400 billion to $1 trillion of spending. It's been growing fairly steadily. It's now forecasted more than double over these years. What is it about businesses that causes them to not cut the spending, but just keep on increasing the spending? How is it that they don't have enough choices with what's called cheaper sources of that same service, and instead they just keep spending more and more?
Standardization, training costs. These are some of the biggest issues. When we bring a new employee on to one of our private companies, we want them to be trained on the same service or utility that everybody else understands that already has been trained on. So you're making an investment in time, in employees' time. And so you standardize on Salesforce, you standardize on Google, you standardize on Microsoft Teams, whatever it is, you standardize on Zoom. We've probably bought more seats on Zoom than anything over the last 18 months because we've used that as a standard in how we communicate directly with our buyers and our marketing teams and our social media people. And all of these things become standards, and those companies hold on to their customers and they grow with their customers as the businesses grow. But I don't think we've changed platforms in 3 years. We don't want to relearn anything. We stick with the standards, and those companies become huge. 36 months ago, nobody knew what a Zoom was. Now it's like Kleenex. Everybody talks about it around the world. That's just one example.
And the switching cost is really the reason, I guess, that people don't switch, just too expensive. And actually, these companies don't charge their clients all that much. They just have a lot of clients, and that's why they grow. And we know we spend a lot of money at our small business here, and we don't switch suppliers. One more slide here on cloud. I want to show people here because it shows how the OGIG index works, and in terms of what kind of cloud-related stocks get selected and included. It is not every single one of them, but it is a set of stocks that comprise 56% of the global market in terms of their total revenue. And so what I want to explain to people is the stocks are selected first because they're in the right sector that qualifies, second because they have quality balance sheet and profit margins, and then third, very importantly, they have strong revenue growth. And our research shows that revenue growth really, really matters across the technology sector. So here we have these companies, the blue slice of pie that is almost a quarter. It's quite a range of SaaS and cloud-related companies. Below that, a list of names that you all know: Microsoft, Amazon, Google, Alibaba, Tencent. And then the big blue piece is cloud-related companies that are not in OGIG. Why are they not in? Because their revenue growth rate is lower than those that are in. That's the primary reason they get excluded. So Kevin, you look at this pie chart. What is it about the pie chart that maybe excites you as an investor using the OGIG index?
Because it reflects the new economy. It reflects what's happened over the last 3 years. It reflects where goods and services are moving to on a digitized basis. And these companies are showing you that they're successful by just their quarter-over-quarter growth rates. I mean, this is not a speculation. This is a fact that the economy has changed all around the world. It was out of necessity that this occurred. And it really is reflected in this pie chart in terms of where goods and services and dollars are spent in supporting businesses in all 11 sectors of the economy. I don't care what sector you're in. You can be energy, auto, consumer, or biotech, or whatever. It's all basically gone digital. And these are the companies that provide that infrastructure. And so in terms of any diverse portfolio, you want to reflect what the economy is doing. You want to be part of that growth. That's how you achieve what the market gives you in terms of economic growth. And this is a big sector, a very important sector. It obviously is providing services to every sector because everybody needs these services, and it's reflected in the OGIG index.
Now, how do you feel about using the OGIG index that excludes almost half of the companies that are in this space, that big piece of the pie chart, and including those that are 56% of the global market, but not all of it?
No, I'm happy to do the exclusions. If they're weaker, they have weaker balance sheets, or they're not growing as fast, or they're not market leaders, I don't see any reason to own them. You don't have to speculate that way. You want the behemoths. You want the ones that are successful, that have momentum and have geometric growth. That's how you should index them. That's what OGIG does. It's like the difference between owning the NASDAQ 100 and owning OGIG. The NASDAQ is anchored by all kinds of dinosaur companies that reflect yesteryear's economy, not today's. And so you want to capture the growth that the new digital economy is putting forward.